In this video, I'm going to talk how to compute free cash flow to firm using the information given in financial statement. Free cash flow to firm by definition is the cash flows in excess of all expenses required for day-to-day operation, growth and development. Free cash flow is available to firm either to distribute to its owner or do something to enhance its value without affecting its regular business. It is very important in business analysis and valuation. Computation of free cash flow has a lot of variations, and I'm going to focus on what I think is easy to understand. We can arrive to free cash flow to firm using either cash flow statement or balance sheet and income statement. So if you want to calculate free cash flow from your cash flow statement, you can simply compute this free cash flow as equals to your cash flow from operation, right? Operating cash flow, and you subtract your capital expenditure and you adjust the interest payment. So that would be after tax interest payment. So by doing this, you can get the free cash flow. But I want to focus how to compute free cash flow to firm given the information in income statement and balance sheet. To illustrate this case, I have income statement and balance sheet for ABC Inc. for the last 2 years. Let's use this information and compute free cash flow for this ABC for this year. So to save our time, I have summarized everything in this table. So to compute free cash flow, I always prefer to start with net income and make all the adjustment needed to get to free cash flow. So the first adjustment is always depreciation and amortization. Depreciation and amortization is always an expense in income statement, but in real sense it is not a cash outflow. The second adjustment we need to make is capital expenditure. So the capital expenditure is always a huge investment and it always takes the cash out. So that's why you subtract it from net income to get to free cash flow. So another adjustment you have to make is the change in operating current assets. So whenever there is a change in operating current assets, it affects the cash inflow or outflow. For example, there is increase in operating current assets like inventory. That means you used cash to build up that inventory. That is why you have to subtract the change in operating current assets. Similarly, you have to adjust for change in operating current liabilities. So whenever there is increase in operating current liability, that means you did not pay all the cash that you were supposed to, right? That is why you have to add your increase in operating current liability back to net income to get to free cash flow. So another adjustment is after tax interest payment on debt, and the last adjustment is after tax interest on cash and short-term investment. So these are the basic adjustment you have to do. So with this said, let's compute free cash flow for this ABC Inc. for this year. So you always start with your net income. Please notice here, to make this calculation easy, I have made the color of the text same in the text and the income statement and balance sheet. So to start, let's see the income after taxes. So this 352 is the same as the income this year for ABC. So and here I have depreciation and amortization 220. That 220 is exactly from the depreciation and amortization for this year, right? That goes here. And now capital expenditure. How much did this ABC Inc. spend on capital expenditure? How do you calculate? So you look at this year's fixed assets and you look at last year's fixed assets and you see the difference, and that difference gives us how much fixed assets was added, right? That's why here 333 is the difference between this year's fixed assets and the last year fixed assets. That's how you compute the capital expenditure. And change in the operating current assets, what you do is you look at this year's current operating assets and you look at last year's operating current assets and you find the difference this year minus last year, and you compute this 22 is the change in the operating current assets. Similarly, you compute change in the operating current liabilities, like you look at this year's current liabilities and you look at last year's current liabilities and you subtract last year's current liabilities 117 from this year's current liabilities 129, right? So the difference is 12. And after tax interest payment is how much interest you paid on the debt, and that should be considered after tax. That's why 32 is the total interest was paid this year times 1 minus tax rate equals to 19.20. That gives us the after tax interest payment on debt. Similarly, you look at after tax interest on cash and short-term investment, and here you see 33 is the interest income on cash and short-term investment this year. So you multiply this 33 by 1 minus tax rate, and this equals to 19.91, and that gives us the after tax interest on cash and short-term investment. So once you compute all of these, you sum them all and you get the free cash flow for this year. I hope this makes sense. Thank you.